I'm joined now by Eddie Ghabour, who is the co-owner at the Key Advisors Group. He joins us now. Eddie, always a pleasure to speak with you, and thanks for taking the time here this morning. Dow posted its worst day since 2020 on Friday due to the fears over the new Omicron variant. I want to get your take on this. Was this an overreaction, or is this warranted considering how much we do and don't know still about this particular variant and the efficacy of the existing COVID response protocols, from vaccines all the way to social distancing, if you will?
Well, from a one-day trade perspective, I do think it was an overreaction, but let's still understand that we've told our clients, we just sent out a video this morning, it's still too early to tell how severe this variant is and what the reaction is going to be from a global perspective. Because if you start to see countries shutting down travel, I mean, that's going to be very inflationary, because now you're going to have these supply chain issues get worse again. You're going to start to see economic activity and consumer behavior change as well, too. And that could cause GDP to decelerate. So it's still very early to tell in regards to really what type of economic environment this is going to create. But from a market perspective, one of the biggest things I'm going to be watching today is the VIX. The VIX had a huge spike on Friday. And if we can hold these gains that we're opening up with today, I think that's going to be very good from a short-term technical perspective. But with variant or no variant, we were telling our clients that we were going to use the month of December, that we thought we would see a Santa Claus rally, and take that and sell into the strength of the market, because we are not very bullish for the first half of next year because of the setup with inflation.
And so with that in mind, how much of an impact do you expect this to continue to have on some of the reopening plays that we have seen the market latch onto or attempt to latch onto? And what could this potentially even do for some of the stay-at-home stocks that have sputtered?
So what we've told clients is, right now, with a month left in the year, this is not the time to try to be a hero and time a reopening trade, because I think the risk-reward setup is not very, very good. Because they've already had an amazing run this year, and you started to see them sputter out a little bit even before this new variant was announced. And so I think you're going to start to see some of these reopening trades really, get hurt from just consumer behavior because of the concerns of what this variant could ultimately turn into. So I think right now investors need to sell into strength based on their risk tolerance. And the biggest thing that we've been telling investors is, now's the time to start thinking about playing defense going into next year versus pedal to the metal, which is where you should have been in the first quarter of this year, not the fourth quarter, especially the month of December.
Okay, and so where are the opportunities that you're still seeing within the markets, especially considering some of the broader kind of sector movements that we've been tracking over the course of not just this quarter, but over the course more broadly of this year? Tech valuations have continued to come under scrutiny. Do you see any opportunities where there may be an opportunity to perhaps get more into one sector versus another, and where might they be?
So I do think mega cap tech is a pretty good setup here, because it kind of is a hybrid in the sense that if we have a risk-on rally, they'll do well. But when we have big sell-offs, they seem to have a lot lower volatility than other sectors. And so we came into the fourth quarter overweight small caps. We've increased our large cap exposure to mega cap tech and some large value, but we were doing it as a shorter term trade, because we're going to start again taking profits to the fourth quarter and start adding to things next year that haven't had a great year, like more of your staples and defensive plays. And we'll probably hold some cash going in the next year, because think about this from an inflationary perspective. You should expect to see the GDP decelerating in the first half of next year, with a Fed that's in a really tough position that they're going to be tapering and possibly accelerating that tapering. In that scenario, I use a common sense approach to that. It tells me that's not a real good setup. So again, not being a hero here, maybe that's why my Twitter handle's Common Sense Bull, because I think that's common sense right now as you look into next year.
With November coming to a close, and we're soon to get even more economic data about the state of employment in the country, what are some of your biggest takeaways from this month's trading activity, especially as it relates to what's been set up on the economic data front, whether that be on the employment front, whether that's on retail sales data that we had also seen, and many of those retail companies had reported earnings over the course of November as well?
I think what you're seeing is, number one, it's the supply chain disruptions is a real big issue. It really is. And that's not going to get solved overnight. We have several months of this to deal with. And so the market has been sending a lot of mixed signals. And when you're getting those mixed signals, there's not one area that just shows strong conviction over the other. And when you see a lot of these mixed signals, is again a sign as an investor to try again not to be a hero and make a huge bet in one particular area. Now, I do think Friday, because of the big sell-off that we had, and even though it was on low volume, did kind of give us a nice setup for December to get that Santa Claus rally that we all would like to see. But again, I know I keep repeating myself. I would use that strength to really lighten up here. This is probably the most conservative that we've been in going into a new year in a very long time.
We've been continuing to track some of the airlines as well that got hit hard on Friday with the Omicron variant. What most notably would you be tracking within the travel space that had been trying to open up as best as possible, has battled everything from labor shortages to even just having to rely on leisure travel in the airspace, as opposed to some of the profit-bearing business travelers that were in play prior to the pandemic? And in this particular segment, is there any opportunity where you see them navigating into 2022 with some potential upside, especially considering the fact that there has been so much of the focus on where business travel would eventually come back?
You know, that travel space right now is not an area that I would like to even touch, because I think when you look at the dynamics, especially now with this new variant, you already have countries that have cut off travel just for certain areas. That's going to hurt the airlines. You know, oil prices are going to weigh on airlines as well, too. And then again, the dynamic that you really can't measure yet is consumer behavior. There's going to be people that were thinking about traveling that may have second thoughts on traveling. So I would expect to see cancellations, and that's something I would really look at if you're trying to look at, you know, the travel sector, is see what type of cancellations that we start to see the consumers make over the upcoming weeks. Because again, if this new variant really spreads, you're going to start to see that behavior change. And so to me, that the risk reward setup for that travel sector is just not anywhere I want to be at right now as an investor.
Eddie Ghabour, who is the co-owner at the Key Advisors Group. Thanks so much for the time this morning, Eddie. Appreciate the insights and perspective as always.